There's been a lot of investment banking business across all spectrums of senior housing and care, whether it's HUD lending, M&A deals, tax-exempt financing, Fannie Freddie. And I'm here with Brian Pollard with Lancaster Pollard, obviously a principal with the company, with me today. And Brian, I think people think of Lancaster, or they used to think of Lancaster, really more on the tax-exempt side of the market, and I may be going back 10 years or so, but that's not really the case. What's the breakdown of your financing activities today in terms of the different sectors?
Well, that's right, Steve. We've been focusing on funding for healthcare and senior living for 25 years. So for the first 15 years, we did have a higher concentration of activity with nonprofit owners. And that was probably driven by our investment banking roots and the use of tax-exempt bond financing for many transactions. And tax-exempt bond financing is really a funding source that's mostly available to the not-for-profit sector. So our client base reflected that. Over the past 10 years, we have broadened our base in the for-profit senior living sector. And currently about 70% of our clients are in the for-profit side of ownership.
That's a huge swing.
Yeah, it certainly is.
And then you've seen incredible growth in your HUD financing business. When did that really start to take off, and what precipitated that move?
Yeah, well, we had also been doing HUD for quite a number of years. We've been a HUD approved lender for 23 years, and had consistently used that program over that 23 years, but not in the volume that we're doing today. It was really the introduction of the lien program in 2008. We were introduced to it early. We saw the commitment of the HUD personnel that were putting that program together. We felt that it was a genuine effort to make the program truly workable, because it had not been up until that point in time. You got very inconsistent outcomes with HUD. And so we started to gear up our staff, our bankers and our underwriters and our analysts to become proficient in the new lien program. And then late 2008 happened. We had the financial crisis. We had the banks basically shutting down their funding of transactions. We had interest rates starting to come down, and we had a lot of people that started to look at HUD that had never considered it. And so we were in a good position at that time to take advantage of that increased volume.
And your volume has definitely increased, right?
It absolutely has.
Can you describe your typical client, who you're kind of targeting on the debt side?
Yeah. Well, we're working with clients that that own or operate properties across the continuum, everything from independent living with and without supportive services to assisted living to memory care, SNFs, continuing care retirement communities, all the way to hospitals. And we've worked, as we touched on earlier, both nonprofits and for-profits, and then we have a number of clients that are governmental entities. In terms of the size of our clients, everything from the largest regional owner-operators to single-site owner-operators. So it's the full spectrum.
And how have your debt clients responded to the 100 basis point increase in rates over last summer?
Yeah, well, I think those that started the funding process before May is when the rates really took off. It's been frustrating for them. When they started the process, they had an expectation of a rate with a 2 handle on it, and that quickly moved to a 3 handle, and in today's market it has a 4 handle on it. And so I think it's been a frustrating process for many. There have also been a number of other clients that did not start the process, that were kind of waiting on the sidelines for rates to start their uptick, that are now scrambling to get in and try to get permanent financing in place before rates go up any higher. I think that everyone expected rates to move up. I think it's just been the speed of which they've moved up that has frustrated many of our clients.
Well, but when you look at the market, well, obviously HUD financings and refinancings are less generous than 6 months ago. It still is very low cost. I mean, are the borrowers just sitting there kind of kicking themselves because they missed out on an opportunity? I mean, you still have low cost debt.
Yeah, that's right. I think it's mixed. I mean, you're right. It wasn't that many years back that, 30, 35-year fixed rate money at 5 or 6% was considered pretty attractive. Now, those organizations, those senior care providers, especially the SNFs, that have been able to get funding at 2 handles or even 3 handles have put themselves in a very nice position, for dealing with the pressures that I think we all know are going to be inevitable in the space going forward. But the senior care providers, unlike more traditional asset class owner-operators, are not quite as interest rate sensitive. And I think many do recognize that even with a 4 handle on it, historically speaking, it's a very exceptional cost of capital. And I can tell you that our backlog of refinance business is larger today than it has ever been in our history. So I think that many do see that as being the case.
Yeah. And then besides HUD, what other lending areas are you guys actively pursuing?
Yeah, well, we are still doing a fair amount of Fannie Mae, of USDA guaranteed loans, and of placing loans with either commercial banks or finance companies. And then we're still doing a fair amount of tax-exempt bond financing for our not-for-profit clients.
On the hospital side or the senior housing side?
Senior housing side as well. The tax-exempt markets had gotten a little backed up several years ago, but they've improved, and the volumes of tax-exempt financing have picked up in recent years. We also introduced a private equity fund last year that is owning senior care assets for lease to what we consider to be best-in-class operators, and we've got 5 transactions that are currently in development, actually under construction within that fund. We just got our first certificate of occupancy on the first property. And then we've got several acquisition deals that we're working on with clients through that equity fund that we hope to close in the not too distant future. And then here over the past week, we have rolled out our own balance sheet bridge funding program. We've placed several $100 million of bridge financing with banks over the last couple of years, but sometimes our clients just don't have the time. Either it's an acquisition constraint, time constraint, or they have debt that's maturing, and they need to be able to move more quickly, and that's the purpose of this proprietary bridge product.
Right, more quickly than a regular commercial.
Absolutely, yeah. They're just not going to have 60 to 90 days sometimes to get the bridge financing in place, and that's the purpose of this product.
Right. You brought up the private equity fund and some acquisitions. Let's talk about the M&A side. You've mostly been known on the debt side of the business.
That's right.
Are you growing your M&A business? Is that something in the future?
Well, it's something that we definitely have our eyes on. We clearly believe that M&A activity, which has been robust for the last few years, but with the competitive pressures and the changes to models of care and changes to payment for care, the need for access to low-cost capital, that scale is going to continue to be important. So we believe that the M&A activity will continue for many years to come. We're obviously not only involved in funding many of these acquisitions, but through our investment banking arm, we are serving as sell-side advisors. And so that is something that we expect to grow in years going forward.
And on the sell side, is it more assisted living, skilled nursing?
It's a combination. It is typically smaller operators, from anywhere between 1 and 10 properties, and it's been a mixture. It's been a mixture of both assisted living and skilled nursing, okay. Including many nonprofit organizations who as Medicare and Medicaid in particular have gone from cost-based reimbursement programs, to flat payments for, based upon the acuity of the residents. I think many nonprofits with their higher cost structures have had a difficult time competing and are deciding to exit the business.
Mm-hmm. And I know you had a nice amount of growth in your debt business in 2013. 2014-15, are you seeing continued growth in the financing business and the M&A business for kind of across all sectors of Lancaster?
Yeah, we absolutely are. As I mentioned earlier, our refinance pipeline is greater than it's ever been in our firm's history. The other thing that we're seeing growth in is new development funding. There was a relative dearth in new construction funding over the past 4 to 5 years. We know that the fundamental demographic trends are supportive of new development, and without much of that over the past 4 to 5 years, we're seeing that backlog hit the market, and so we've seen our new construction activity pick up considerably.
Good. Well, good luck for next year, and wish you continued success.
Thanks a lot, Steve. I appreciate it.
Thanks for meeting with me.
Yeah, it's good to be here. Appreciate it.